Ladies and gentlemen, welcome to the Q2 and H1FY25 results conference call of Senco Coal Limited, hosted by Emkay Global Financial Services. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Devanshu Bansal from Emkay Global Financial Services. Thank you, and over to you, Mr. Bansal.
Hi, good morning, everyone. I would like to welcome the management team of Senco and thank them for this opportunity. We have with us today Suvankar Sen, Managing Director and Chief Executive Officer, and Sanjay Banka, Chief Financial Officer. I shall now hand over the call to the management for the opening remarks. Over to you, sir.
Yes, good morning, everyone. Good to talk to and meet all of you over the call. We are here today to talk about the Q2 performance of FY24-25 and also the overall H1 performance for Senco Coal Limited. Before I get into the numbers, I would just like to kind of bring to your attention on the way the Q2, which is July, August, September, has been. So towards the end of July, we have seen a kind of an incident, which was the budget. And it was the good initiative of the government to reduce the duty on gold price to 9 to 10% duty, and that fall in gold price led to a very positive result on the overall sales for the industry as well as for us at the company. So that was one of the triggering points for the month of July. If you look at August was, I would say, it was kind of a mini Dhanteras. Usually Q2 is a quarter which is comparatively slower and lower than the rest of the quarters in the year. But this time we have seen that Q2 numbers in terms of top line has been a higher number compared to Q1 itself. So Q1 was a quarter for Akshaya Tritiya and New Year's in many states. But maybe it was the election, the heat wave, for which in spite of the growth, a lot of the sales passed on to Q2, and especially with the duty cut happening and the prices coming down. And then as we ended August and we moved into September, we saw that it was a full focus on the preparation for the Diwali and Dhanteras and Navratri season. And on the other hand, we saw that the gold prices were moving towards all-time high in the month of September. So while the planning for the festive season was full on, but these price volatilities that happened during this particular quarter did act as a little bit of, I would say, hindrances for which we had to go ahead and take more gold loans and arrange funds and arrange for the stocks for the festive season. But all in all, coming to the numbers, if we look at it, we have registered a 27% growth in Q2. And if you want to break it up, you will see that the value growth overall in gold was about 30%, and in diamond it was about 9%. And in terms of volume, we always tell that, when the gold prices move up, then we see value growth, but we usually see a volume degrowth. But we have seen that as far as gold was concerned, we have seen a volume growth of 7%, and in diamonds we have seen a volume degrowth of 3%. Now that behavior of consumers that we saw was that when gold was on an upward trend, people who had to buy thought that it is better to buy gold than buy diamonds, and diamond prices were also under pressure. So that is where we could see that there was an inherent demand for consumers to buy gold, maybe for their weddings, maybe for their self-investment, but that was the scenario. And if we look at the overall H1 of this particular year compared to the previous year, we have seen a 17% growth overall. And here, if we look at it, the volume growth for H1 overall for gold was only 1%. In diamond, we have seen a volume degrowth of 8%, and a value growth in gold for H1 compared to last year was 22%, and a value growth in diamond of 3%. So such is one scenario that we need to take care of. The second part is that here, while Mr. Banka will take you more through the numbers, what I would like to just guide you all is that whatever numbers in terms of EBITDA and PAT that we see, you must consider that the duty cut that was impacted, and we had discussed on it before as well, is approximately 27 to 30 crore of that duty impact has also been taken into account in the Q2 results. So that is something that we must keep in mind. It was a one-time impact which we will be taking over the Q2, Q3, Q4 maybe, and but other than that, whatever growth, whatever numbers we see is with taking that into account as well. Now, when we speak of diamonds and the initiatives that we have taken in terms of launching new collections, we launched the wedding collection. We have been in the middle of Independence Day, the festive sales, and various kinds of such initiatives were taken to make sure that our diamond sales go up. So in terms of ATV, ASP, we will see that we have grown by about 12%. So that was led by the increase in gold prices and led by the fact that consumers' budget was up for this particular season. And in terms of number of invoices also, we have seen that there has been a 12% growth in terms of number of invoices. One thing that kept this industry growing against the other sectors is the old gold exchange. And we have seen that there has been a 34% increase in terms of the use of old gold by the consumers. So when the gold prices go up, consumers feel that the old gold lying in their houses are something that must be utilized. And I think, through our policies of ensuring that the customer do not lose out anything when they will bring their old gold, not only from Senco, but from other jewelers, family jewelers that they have bought as well. And I think that is giving a lot of encouragement for the consumers to come and buy and exchange their old gold. And out of the old gold that was exchanged, we must say that 62% of the old gold that we received continues to be a non-Senco old gold. So this is a signal that yes, a lot of a shift from the unorganized to organized continues to happen in the current scenario. If we look at the way forward, Dhanteras month is something that we all faced in the month of October. There was Navratri, there was Dhanteras, and I must, I'm very happy to tell all of you that this October month we have done the best ever sales for Senco in the history of Senco. So we crossed 1,000 crore sales for the month of October, Navratra and Diwali, Dhanteras all being in that same particular month. And we are very positive that yes, the wedding season is about to start. We have already seen in the post-Dhanteras also with the geopolitical situation and the way the US markets are behaving, the gold prices are on a downward trend, which I would feel that will only encourage consumers to come and buy for the upcoming wedding season more. So yes, while at one end, in terms of the estimates and the thought processes on what kind of growth we are looking for the year, we are looking at around approximately an 18% growth year on year. The gold prices have been on an upward trend, but let us assume an 18% growth year on year in terms of top line. In terms of bottom line, our endeavor from the very beginning was to grow about 15 to 18%, but we just need to keep in mind that this one-time loss for the duty of 50 to 60 crore is there. We are taking all kinds of initiatives, how we can control cost and how we can increase the sales of diamond. But if you look at the Q2, the diamond growth has not been that much, but we continue to bring out new designs, new collections, and marketing campaign. We've done a lot from September itself, launching our Aparupa collections, men's jewelry. We are happy to inform all of you that now, along with the fact that we have Vidya Balan and Kiara Advani as our national brand ambassadors, we wanted to focus on men's jewelry in a big way, and we've brought in Kartik Aryan as the brand ambassador for men's jewelry, targeting the younger crowd and the younger generation. It's a new segment. It's been last 3-4 years. We wanted to always focus on men's jewelry as a category, which is about 15% of the overall sales. And I think that we need to look at the future, look at the new generation consumer, and with the movies that are coming out and the movies that are getting successful, I think it will have a positive impact as we continue to grow all over the country. And in terms of store openings, one must agree that we have opened one Senco company-owned, company-operated store. We have opened about 4 Senes stores focusing on the lab-grown diamond jewelry and leather accessories. This particular coming quarter, we will be launching our perfumes range under the Senes brand also. And franchisees, we have opened 2 franchisees. There are more in the pipeline. So, but while the new franchisees getting added were this particular quarter lower, what we must share with you that in terms of the Q2 growth that we have seen, franchisee growth with the existing franchisees that is there has played a very big role in the overall growth of the business. So, be it in terms of diamond sales growth we talk about, in terms of gold jewelry sales growth we talk about, the primary sale to franchisee and the secondary sale that we saw the franchisees getting from their markets, which is usually the tier 2, 3, 4 towns and cities, has been the one which has actually driven the Q2 growth for Senco Gold Limited. So now I will request Mr. Banka to take you through the numbers and further we are there then to take queries.
Yes, sir. So thank you very much, sir. A very detailed background has been given, and it is the result of this excellent initiative that the business has taken, that they have transformed into good numbers. So as you said that the retail business in the quarter had grew by 27% and 19% in H1. So let me give the consolidated result first. So for the H1, including that of Q1, so the top line grew by 18.5% from 2452 crore last year to 2904 crores. Comparing YOY H1, the EBITDA YOY grew from 106.7 crore last year in H1 to 160.7 crore this year, almost a 50% improvement. Similarly, the PAT, which in H1 last year was 39.6 crore, has grown to 63.4 crore, a 60% improvement. And this is despite the fact that we have taken impact of around 29.83 crores on account of custom duty. So our total impact is likely to be around 58 to 60 crore. So now that 29.83 has come in Q1, balance amount impact will come in Q3, that is H2. So this is on account of YOY consolidated. If we look at standalone number for Q2, they have also improved very significantly from 1157 crore in Q2 last year to 1515 crore in Q2 this year, indicating a 30% improvement. And similarly, PAT, which was last year small sum of 10.6 crore in Q2, has improved to 14.2 crore, a 33% improvement. So overall, the financials are reflective of the various initiatives which we have taken. Now, if we talk about the balance sheet, which we have shared, the balance sheet is also becoming stronger, and as the business has grown. So particularly the balance sheet of the company for September and March, they are prepared ahead of the festive season. So the 30th September balance sheet is prepared ahead of the requirement for festive season, that is Dhanteras. So our balance sheet primarily has seen movement of borrowing. the borrowing has increased by 238 crore. But a major part of this increase is on account of gold price rise as well. So versus last quarter and this quarter, the gold price last quarter rose at 7158, and this quarter rose at 7486, almost a 4 to 5% increase. So that leads to increase in the gold metal loan mark to market pricing and leads to increase in the borrowing. Secondly, there is also increase in trade payable. So this is on account of the festive readiness. And these two increases and movement in the balance sheet has primarily been on account of inventory, which has increased by almost 301 crores. So that's on account of PL and balance sheet. And as you've said about the hedging, we have said that our hedging policy is talks about a minimum of 50% hedging, while we have said that we will keep hedging around 80% or 80% plus. So as far as this quarter is concerned, our hedging was almost 85% as we ended the quarter. So with that, I think we can open the floor for question and answer, and we can address your queries. Thank you very much for joining this call.
Thank you very much, sir. We will now begin with the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Raj Saraf from ProInvestor. Please go ahead.
So very good morning, sir. Hello, I'm audible?
Yes, sir. Please proceed.
Yeah. Sir, as you can see, a healthy growth in top line, but EBITDA and PAT took a hit. As you mentioned in the opening remarks that duty cut impacted EBITDA by 29.83 crore this quarter. So you also mentioned that the balance 30 crore will be in Q3. So no impact in Q4, sir? Am I listening it correct?
So your understanding is correct. So as you know, this impact is based upon the inventory turn. So let's say that 25 or 2800 kg of gold that could not have got sold in the Q3 itself. So ideally the impact should come within Q3 itself. That is what we can say. There may be very small carryover in Q4, but overall impact will come in this year itself. So in March 25, the impact will definitely come.
So the total impact, sir, leftover impact is 30 crore, sir, in this year. Yeah,
maximum. Correct.
Yeah. And sir, as you said, we already have north of 100 crore sales in October, which is 60% of the last year Q3, sir. Now having very good season, wedding season ahead. Are we not being very conservative in guiding for 18% for the entire year, sir? Are we not seeing any growth in Q4 if we are saying 18%?
No, October has been a very positive month. After Diwali Dhanteras, usually we have a 7 days, 10 days of lull. But now the wedding season is in full force. So I think from our perspective, while in our mind we want to be as positive and aggressive, but as we come closer to the year, we would rather have a conservative approach and then try to perform better than what we are estimating. So yes, 1,000 crore has been a great quarter. But last year, if again to add to that, let me give you another picture, and it is for everyone. That last year Dhanteras was in November, 10th of November, 11th of November. So if we look at the overall scenario YTD, then we will see that our growth is around 15 to 18%. So I think it's fair and to take a 18% approach and then keep working towards trying to achieve more.
Mr. Saraf, I would request you to kindly rejoin the queue for follow-up questions, please. There are others waiting. Thank you. The next question is from the line of Vidisha Seth from Ambit Capital. Please go ahead.
Hi, thank you. Am I audible?
Yes, ma'am, please.
Hello. Yeah. Hi. Thank you for the opportunity. Just wanted to clarify that given we've seen around 10 billion odd INR sales in the month of October, would it be fair to say that we would have seen a 20% SSG when we compare this year's festive versus last year's festive?
The SSG numbers.
See, Vidisha, the SSG number, what we have said is that is usually around 60 to 70% of total growth. So even for H1, when we are talking about around 19% growth, 20% growth, SSG around 12 to 13%. So similar trend will prevail in H2 and in quarter 3 or quarter 4.
So just what Mr. Banka said is Q2 SSG is 20%, H1 SSG is 12%.
Correct.
So for the month of October, the SSG will be in the range of 12 to 15%. If
for Q3.
For Q3, for October, November,
okay.
For Q3 will be in that particular range. Yes.
Got it. Clear. And the second question was on gross margins. How should we look at the GM movement, as the studded component has not materially changed, and plus last quarter you'd highlighted that there may be some reversal of the impact on GM in the following 3 quarters.
See, with this gross margin, what we have indicated will be between 15 to 16%. Okay. So in this quarter, in console, you will see the H1. I'm saying H1 gross margin. It is always better to look at the cumulative trend instead of one quarter. So if you look at H1 gross margin, that is around 14.7% as against 12.2%. Now, if you look at quarter to quarter, obviously quarter to quarter has come down. So if you look at Q on Q, Q1 versus Q2, Q1 versus Q2 movement is significant. But we've always indicated that since on account the industry is quite dynamic and due to extreme volatility in the gold prices, despite a high hedging of 95%, the IND does not lead to a very symmetric result. It's always better to look at YTD where our gross margin is 14.7%. This is net of the custom duty impact. So if my console is 2904 and if my custom duty impact is 29 crore, so 14.7% is effectively 15.7% gross margin. That is in line with the expectation we have given. And this is despite the fact that the diamond sale across the industry is on a muted side, while we have slightly improved our stud ratio. So we have to look at the number in the larger perspective, where we are very confident of what we have promised we are achieving, and we will continue to do more. While at the public forum, we will be giving a slightly conservative estimate. But internally, we are all charged up given the excellent Dhanteras growth, and we will continue to do more than what we promised.
Got it. And just the last question to Subankar. From an industry perspective, how do you see the studded segment shaping up? And would the consumption be led by the daily wear category or more of the high segment or wedding wear category? I'll come back to
So what I am observing is that the studded share category is currently driven by the daily wear category. The high segment as a segment in the Q1 and Q2 were buying. It was the smaller ticket size items that were not getting sold as much as the higher value products, which is mostly with 2 objectives or 2 reasons. One is the buying happening, and the second was that people who had the disposable income were the ones who were buying more, while the general consumers for everyday wear and upper middle class of smaller ticket size were buying less. But going forward, what we saw the change post or during Dhanteras was that there were many more customers buying daily wear and small items. So if we want the studded share to grow and the strategy to move it forward, we have to focus more on daily wear items. The high value items will remain as it is and is being happening. And those customers are also trying to say that, I might as well buy gold, it is an investment. But because prices of gold has gone up, 22 karat gold is more expensive, so people will prefer 14 karat. Government of India is thinking of bringing 9 karat hallmarking also. So that will make the prices more if that hallmarking is allowed. I hope I'm being able to make clear, to summarize, that the high value segment is what is happening more. The daily wear segment is what will drive the growth in the future.
Got it. Right. Thank you. I'll join back.
Thank you. We'll take the next question from the line of Yash from Stallion Asset. Please go ahead.
Hi, thank you for the opportunity. So you said that October 24, you've got 1,000 crore sales, so congratulations for that. But obviously, this will have some impact of the price of the gold as well. So what has been the comparable volume growth, if you could tell me why for the month of October versus last year?
Yeah, I will tell you that the volume growth would be in the lower single digit. So just let me check and get back to you. But yes, the value of gold compared to last year October is almost up by 24-25%. And let us keep in mind that internationally it is up much higher. It is the duty cut of almost 8 to 9% that is leading to the gold price, whatever it is.
7,480 September.
Yeah.
6,320 was September.
That's right.
And this is 7,486.
So just to give what data we have is, last year it was 6,300 and
5,940 was the closing price
of course 6,000. Yeah. So around 5,800 to 6,000 was the last year value. This is value of per gram, and this year it is approximately 7,200 approximately. So it's almost been a 20-22% value increase. So that is where it is. So the growth exact number we'll tell you. It will be around 3-4% volume growth.
Okay, got it. And so just from from like a growth aspiration perspective, are we satisfied with like a 7% growth in Q2, or do we think that given our brand recognition, especially in the East, we can go volumes at 10% or along those sort of at least a low double-digit kind of rate?
Can you come again? I couldn't get you.
No, I'm saying that do we sort of target to grow by low double-digit in terms of volumes? What is your sense looking at how is the consumer demand facing? I'm just slightly longer-term perspective, 3 to 4 years. I'm saying. Or do we think that on a sustainable basis we'll be able to grow at volumes by high single digits?
So yes, if I take this question, see, volume in this industry, volume growth will lead to asymmetry in understanding, because the consumer does not consume by volume. It is not a consumable product. Let's say petroleum product, I have to use 20 liters every week for my vehicle, come what may. And if I consume less, that means I've stopped my consumption. So this has to be seen in terms of revenue growth only. Volume growth discussion, to my humble understanding, is an academic discussion. So the 20% growth, what we are saying, is what we are confident. Now, if the price remains stable at this range, let's say price increases only by 5%, then the volume growth will be 15%, 5% plus 15%. But if the price increases by 25%, then you can safely assume that the volume degrowth of 5% will happen. Now, this volume degrowth will happen at existing stores, because we give a target to stores, not in terms of volume, but in terms of value. That's my view. Our MD can say something more.
So I think from your side, you are trying to create a model. And in that particular model, if there are two parts to the model. One is how much will you increase the price year on year, and how much will you increase the volume year on year. So adding to what Mr. Banka said, that if you take a estimate of 8 to 10% increase in price year on year, you must take around 8 to 10% increase in volume year on year. If the prices go up, then the volumes will come down. If the prices go down, then the volumes should come up. So that's how you need to take on the whole scenario. Number one. Number two, new store, matured store, but and growing store. So we kind of take a aspect again on a value term that some stores are growing at 15, 18, 20%. Some stores are growing at 10, 12%. Some stores will grow at 7, 8%. So that is how we do our modeling. So on an average, I think that 10 to 12% overall average increase on same-store sales growth basis, and 6-7% for the new stores that we keep adding to the portfolio is what will drive the business. So this is, I think I could answer your question as much as I could.
And sir, if I build on this, if I build on this, suppose my top line is increasing by 1,000 crore, right? So as I say, 70% of this growth will come from existing store. So let's say 5,000 crore versus 6,000 crore is 20% growth. Now out of 1,000 crore, 70% will come from existing store. That is around 12%, 12 to 14%. Balance 30%, that is 300 crore will come from new store. That is 5 to 6%. So this 1,000, if you keep this theory clear of 5,000 and 6,000, 700 and 300, then it will make very clear. Now this 300 will come from existing stores, from the new stores of own and franchisee. Because to the franchisee, we make an upfront one-time sale. But that much sale will come from a store over 5 to 6 months.
Got it. Very clear. Thank you.
Thank you. We'll take the next question from the line of Deepak Lalwani from Unifi Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. So my first question is on the gross margins. So historically, our company has maintained this gross margin of 15-16%. But the breakup of this was that the first half was on the lower side, and the second half was on the higher side of gross margin. So can you explain why this variation has been there? And today, when we have done a higher gross margin in the first half, so can you also explain what has happened, in this first half this time? Is there a material change in the business model? Have you reduced discounts, or is there any change of terms with our franchisee? Can you just give a background of these two aspects?
No, so what happens is that in the second half of the year, we usually see the festive season, we see the wedding season. So keeping your fixed costs the same, we usually have higher value, higher business, higher volumes. Out of 5 years, I would say 3 years behave in this way. And that is where we always say that, yes, the gross margins go up during the second half of the year. Along with that, with the wedding season, then Valentine's Day, all the wedding season is not only about people getting married, but also people who have already got married and want to give something to the wife. So therefore, the probability of diamond jewelry selling happening here is higher. So these all add on to a higher gross margin on the second half of the year. What has happened in this particular H1 is, if you note that Q1, our gross margins went up. Q2, our gross margin has taken a hit because of the duty cut. But in general, this year, this particular H1, our gross margin is in the range of approximately 15%. And I think that in H2, with the price volatility, our gross margin will be in that same range. Overall, in the year, we take a gross margin of 16 to 17%. So therefore, I think there will be a more of a normalized gross margin for this particular year. Certain quarters give us maybe a higher number. Certain quarters will take away the numbers from you. That is number one. Number two, yes, very rightly pointed out from a franchisee perspective, but that is not going to create much of an impact, is where we did our internal rationalization of giving them the margins either in gold price or making charges. But all in all, our franchisees continue to enjoy a margin that they were enjoying before. So I think it is more to do with the business. And Q2, keeping the fixed cost same, the business really went up. And that is where we have seen the benefit. But yes, if we see a lower downward pressure, it is because of the loss that we have booked. Now, if you add on to the particular duty cut loss, then you will see that the picture would look much better. That is number one. But at the same time, let us keep in mind that because the duty cut happened, the sales went up. So these are the multiple moving parts with which we are working. So I hope I could answer your
yes, sir. That
if you want to add something.
Yeah. So Deepak, I will add slightly on this. So as we said that the gross margin changes because the situation in every quarter is not same. The price volatility is not same. Okay. Now, due to this price volatility and situation in the quantity and the exact moment of price rise, so on which date in the previous quarter in Q2 the price change. So while this question keeps coming to us, but the process, let's say in last year quarter 1 was 12.3%, quarter 2 was 11.7%. But as it is 12.3% in Q1 last year, this year we made 17%. And we explained that this is not comparable because then the rub-off effect, let me call it the rub-off effect of a higher gross margin will come in second quarter. So now last year we had 11.7% in Q2. So if you compare on Q2 to Q2, it is 11.9%. But that would be more of an academic explanation, which I can convince you easily. But then, if you look at the custom duty impact, now on a sale of 1,500 crore approximately, we have taken a hit of 30 crores. So 2% has been impacted on account of custom duty only. So what you are saying is 12%, it is 14%. So we suggest that look at the whole year or at least a moving average 3 to 4 quarters, and you will definitely get 15 to 16%.
Sure, sir. That is quite helpful. So one should assume a normalized 15 to 16% margin for the full year, and the second half could also be on that side. Well taken, sir. And so we have, as a company, taken a enabling resolution for a QIP of about 500 crores. So can you explain the rationale behind it and what are we thinking in terms of the usage of this money?
So I'll tell you, it kind of triggered in our mind in the month of August actually, right? When the gold prices, the duty cut happened and the prices fell, and we could see a very good demand at the consumer end. So in the month of August, when we saw the good demand happening, and we were all getting extremely kind of frustrated is the right word, because if we had more stock and more inventory, we could have sold more. So that kind of triggered in our mind that, what is stopping us from growing more is the availability of capital. At one end, we are talking to the banks and trying to arrange for capital and funds. But banks will take their own time, and there is a limit. The debt equity ratio has to be maintained. All those things are one part. And again, while we started seeing the good demand in the month of September, just after that, we saw the gold prices continue to move up at all-time high. And again, you want to plan, you want to have a certainty, but these movements and most of our gold that we take, ability to take gold on a timely manner so that we could fulfill the demand, it is just getting hampered. So we thought that, no, let us, the IPO has happened, it's been 1 year, and we were initially planning for a much higher amount during the IPO, but later on, due to the market condition, we had to agree on a much lower amount and plan accordingly. So now that market has stabilized, and I think that, the opportunities of growth continues to remain. So we have decided that, let us raise a round of QIB for the future growth of the company.
Mm-hmm.
And Markaji, you want to add on something?
Yeah, Deepak, if you look at the gold prices, so when we went on roadshow in the month of April 23, gold prices were around 5,972. Okay. And currently we are at 7,486 or 7,800. The gold prices has increased almost by 25%. So if you look at balance sheet of March 23, my inventory was 1877 crore. If we exclude other inventory, let's say diamond, platinum. Out of 1877, my gold alone was 1407 crore. Since the gold price has increased by 25%, that 1407 crore has also reduced by 25% due to the GML. So 1407 into, if you do 25%, it will come to again to 350 to 400 crore. So 350 to 400 crore is the minimum fund which I require to maintain the same level of gold which was there in April 23. Now between April 23 and today, we have added at least 18 plus 7, 25 stores. And now out of that, at least 12 to 13 are own store. Now 12 own store into 20 crore is 240 crore. So 400 crore plus 240 crore becomes 640 crore. And for next expansion growth, what we discuss in roadshow, for that also we require fund. Moreover, due to increase in the gold prices, the hedging margin has increased. So this QIP is purely in order to maintain the business at the same level, and that's why we are raising this fund primarily for the working capital.
Understood. And sir, any change to our store addition guidance given that we have less capital today? The 18 to 20 stores is possible. Any understanding from you? Can you get
Yes. No. The store addition target continues to remain the same. Gold prices moving up by 20-30% would in effect mean that 20-30% more capital is needed to open the same number of stores, or you reduce the number of stores by 20-30%, right? So there are stores in the pipeline. There are 6-7 stores, company-owned, company-operated stores in the pipeline. There are franchisees, 4-5 franchisees in the pipeline. I think this price fall is only going to enable the franchisees also to arrange for capital easier, faster, and for us also to grow easier, faster. So I think that 18 to 20, maybe at the end of the year, we will end up doing 15 or 14. But in our mind, we have to manifest 18 to 20 minimum that we want to grow with.
Understood. Sir, last question I had on our hedging practice. You mentioned that 85% is the hedging percentage. So is it on sales or is it on the inventory? And secondly, what's the mix between gold metal loan, MCX contract?
So it is on inventory, and then the DA will, Mr. Banka will say.
Yeah. So Deepak, one is that last year it was almost 90% average. In quarter 1 90, quarter 2 87, quarter 3 92, quarter 4 90. This year quarter 1 was 95%, and as the prices rose, it reduced to 85%. It is on the inventory. Once again, inventory means that total inventory less diamond. So whatever the total inventory that you see in the balance sheet around 2800 crore, and out of 2862, you can reduce 400 crore of diamond and other gold platinum. So 22 to 2300 crore of gold is hedged crores. Now, out of that, whatever the GML amount, so let's say the GML amount is almost unfixed. Balance we do at MCX by future sale. This is the practice which the entire industry follows, and we have got a panel of expert advisors who have been working with us, a team which closely monitors the gold price movement and to de-risk the balance sheet and the risk of investors. Because for us, the interest of the investors and shareholders, that is of paramount importance, because we are not running a hedge fund, we are running a business, and hence we have to de-risk the metal volatility to our investors fully.
Mr. Lalwani, I would request you to kindly rejoin the queue for follow-up questions. I would request Mr. Dheeraj Mistry to limit his question to one per participant. Thank you. And we have the next question from the line of Mr. Dheeraj Mistry from Antique Stock Broking. Please go ahead.
Yeah, hi. Good morning, and congrats on very good set of number. So, my question a bit broader. How do you see the competitive? When we saw that there was a gold price surge during first quarter, there was a good amount of competitive intensity was increased by the unorganized player. Now that the gold price is still rising, the demand has been good, mainly because of the festival period and wedding season. But once that phase out, how do we see that the competitive intensity to remain with gold prices continues to moving up?
No, so I think that the competitive pressure will remain because the hunger to grow is in all organizations, and they are using various strategies and various methods to grow. You have rightly pointed out that when gold prices move up in a very short period of time, then to ensure that the consumers' footfalls keeps coming to the store, people take certain more aggressive actions and bring down the prices, give discounts, and so that consumers are coming to the stores. And when suddenly you will realize that when gold prices suddenly come down, like it happened in duty cut, then people take a hit. That intensity reduces to that extent that automatically consumers are coming and they want to protect their books. But again, when it goes up, that intensity will again go up. So for the going 1-2 years minimum, the intensity will remain. That is number one. But at a much broader perspective, we at the industry level is also of the opinion that this is not sustainable. We all have to create our unique propositions. We have to work on the designs, or we have to work on the service, and that should remain, the crux of the business as we continue to grow. So there has to be a sustainable level of growth, and the rest will be based on the individual performances. So maybe for 1 year or this thing will continue to remain, and after 1-2 years, it will normalize. That is what we feel, because industry overall is already talking about how to manage the situation.
Got it. And just follow up on that, can you throw some light between the demand amongst the region when I compare north versus east? And within the east also, how do we see the demand between urban market and rural market? You can throw some light on that as well, please.
Right. So see, for us, we have to say that our strength is eastern part of the country. That is where the company originates from, and that holds to around 80% of the overall sales from the eastern part. North part covers about anything between 10, 12, 13% of the overall sales, and the remaining is done by the south and west. If we look at Q2 particularly, and most of the franchisees that we have is from the eastern part of the country, the growth from the tier 2, 3, 4 towns and the semi-urban or semi-rural markets have been actually the one which has driven the sales for Q2. So I think the agricultural sector did very well, and that is what the result was in terms of the availability of liquidity and also the inclination to buy more gold and all of it during Q2. So Dhanteras, Diwali, we also saw a equal kind of a demand from the smaller towns as much as also from the bigger cities. But yes, because the prices were high, I think that many the smaller ticket sizes were selling more in the bigger cities at one end, and a very high value product for weddings were selling at the bigger cities at the other end. But when it came to the smaller towns, it has been a average ticket size. Say, to give you an example, between say 70,000 to 1 lakh rupees was what the smaller towns might be asking for. And in the bigger cities, we have seen one demand coming at around 30 to 50,000, and the other demand coming at around 2 lakh to 3 lakh. So are you this data will only give you a picture that the bigger cities, there is one group of people for daily wear and one group of people is the one for wedding or high value purchase, and the middle is the smaller towns. So this is the way that we are seeing the demand.
That's very well clarifies everything. Just one request, I failed to find PPT on exchange or on your website. The lot of data has been available in that PPT. Can you share that as well going down the line, please?
So we will do that. As you said, we are going for, so we will update it in next 2-3 days time. Kindly give us some time. We'll update it maximum by tomorrow.
Sure. Thank you very much. That's it.
Thank you very much, sir. A request to all the participants that kindly limit your questions to one per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We'll take the next question from Shirish Pardeshi from Centrum Broking. Please go ahead.
Good morning, Shivankar and Bankaji. Unfair that my chance I'm going to ask only one question. So, Bankaji, when you look at the standalone business, you said the growth is about 30%. But when I see the other expenses, which has grown 39%. So, this 98 crore expenses, can you share what is there? And related question on this is that this one-time whatever loss we are booking, is it the part of other expenses or we have adjusted in some other line item?
See, one-time loss is on account of inventory. See, it is a cost of goods sold. The goods which I purchased at 100 plus 15, I'm selling at 100 plus 6. So the impact is coming in the gross margin. That's what we say, that what you are seeing the gross margin at 11.9%, it is effectively plus 2% more. So as against 1,500 crore, approximately, there's a 30 crore of gross margin impact also.
Okay. So that is the
that is on the gross margin. Which other expense you are referring to?
So he's asking that the other expenses have gone up. So what is mostly your component?
See, other expenses, Shirishji, I will tell you, we have been saying that we have been working on a very agile framework, and we have said that Calcutta is our strategic locational advantage. Now, having said that, as our desire to grow, we talk internally about minimum $1 billion and $2 billion over the next 5 years. We have to build up our system, people, process, technology, training, and the entire infrastructure. We are also investing highly on the customer experience. We are investing heavily in technology for CRM. We have metaverse. So this is not expenditure. This is investments toward the future. Although as an accountant, it is coming in financial and other expense, but this is all investment for future.
Okay. Just one quick follow-up on this. So we have a substantial number of franchise. So under this custom duty reduction, have you covered the franchise inventory also?
No, so when we are hedging, sir, the franchisees inventory is on their books. So that is not hedged by us. So that's the plus and minus that the franchisee has to take on their books. So we are only hedging the inventory that is lying in our books, which is either the inventory lying at the stores or inventory lying at various warehouses or head office.
Okay.
So franchisee have their own hedging policy. The good thing is that franchisee have made money on account of rising gold price. So if the gold price has risen by 25 to 28%, they have made money. So similarly, they have taken a one-time hit, but they are very clear that long term the gold price will continue to grow. While we have been encouraging the franchisee also to do the hedging, it's their own business decisions, and they are happy with their business model. And we did not interfere with the franchisee in their business model also.
Mr. Pardeshi, I would request you to kindly rejoin the queue for follow-up questions. Thank you. We'll take the next question from the line of Vikrant Kashyap from Asian Market Securities. Please go ahead.
Good morning, Shivankarji and Sanjayji, and must congratulate on your performance YTD. My question pertains to Senes portfolio. So in the opening remarks, you mentioned that you have added 4 Senes stores. So does this mean that you have taken the total count for 8? And what is your strategy going ahead for the LGD portfolio?
So first, the strategy for the LGD would be that, we wanted to create Senes as a brand, which will fulfill the aspiration of the upper middle class, bringing in products which are of, say, international design, international quality, but at prices which will be, something easy on the pocket. That is number one. Number two is that just bringing out a normal lab-grown diamond jewelry would only, not add much value to the jewelry, and that is where Senes would come out as a lifestyle and a design kind of a branding, and so jewelry design, bags design, adding to that the lifestyle aspect of perfume. So this is where overall the Senes brand as a modern new age brand that can open stores in malls and cater to the aspirational young generation India is where we wanted Senes to stand. Because the moment you think of Senco, you think of tradition, you think of trust, you think of the jewelry, the legacy, but you don't think of some kind of modernity, in spite of the fact that we are coming out with brand ambassadors, young generation, all of that. So this new brand has to have a new look. So this is where Senes wants to be positioned themselves as. And in terms of the new stores that got added for Senes, we have stores in Calcutta that we got added, and there were 2-3 stores in the previous quarter that we had in Delhi and Chandigarh. So and upcoming stores of 3 more stores of Senes will be added. The total number of Senes stores. Now, Senes bags are available in many of our Senco stores as a shop-in-shop itself. And exclusive stores of Senes, EBOs as we call it, is now that are being created. So I think total 6 is there. Yes. So we have 6 stores in totality. So if I've said 4, maybe it is my mistake. It is 4
Mani Square, Forum Mall, City Center, Airport,
Lajpat Nagar,
and one more. L&T Mall.
Yeah.
6.
So total we have 6 stores of Senes and 2-3 more in the pipeline. Yeah.
Okay. So
by the end of the year we will have 8 to 10. I think that is what we are looking at.
Okay, great. And just follow up on the LGD. So we are looking at affordable price points for lab-grown diamond, or we will have some bigger pieces also. Which of the portfolio we are targeting?
So mostly bigger pieces, 30, 40, 50 cent and above. Not the smaller size diamond. The smaller size diamond could be an additional feature to the big size diamond, because as we all know that the value difference and the value proposition of lab grown is in the bigger size diamond and not on the smaller size diamond. So that's how we will want to position that.
See, basically, Vikrant, this is for the aspiration of the middle class, where they want to own a solitaire of, let's say, 1 carat of, let's say, 4 lakh or 5 lakh, and which takes them 10 years. So a solitaire of 1 carat of a lab-grown diamond can be afforded in 40 to 50,000 also. So that is what is and the margins in the lab-grown diamond are slightly superior than the natural diamond. So it is better. It is better that way to keep this market also on and not to lose sight of this market, and depending upon what is the dynamics of growth in this market, and particularly. And second, the small size diamond, what we said, our majority, the stud ratio of 11-12%, which we say, majority of them are below 7 to 8 cent, 7 to 8 cent range. Now in 7 to 8 cent range, a lab-grown diamond will not make economical sense. The price differential will not be very low, and then the realization price. So we are looking at, as sir rightly said, more than at least 30-40 cents for as a solitaire product.
Thank you. Mr. Kashyap, I would request you to kindly rejoin the queue for follow-up questions, please. The next question is from the line of Devanshu Bansal from Emkay Global Financial Services. Please go ahead.
Yes, sir. Hi. Congratulations on a good festive in October. So, Ankur, some of the retailers in other categories like apparel are indicating challenges due to protests in Kolkata. So I just want to check how should we see your Q2 numbers? Had this incident not taken place, would our growth been even better versus what we have reported?
No, I don't think that the events that has happened in Calcutta had much of an effect on the jewelry category, because jewelry is more planned, and people who have to buy will be buying for whatever their occasions are. It is not so much impulsive as the other apparel or other categories would be. So yes, before the Durga Puja, there was some amount of kind of sombrity and little bit of the sentiments were low, and that picked up much late, more closer to the puja date, and that's why the other brands faced what they had to face. But for us, the main season for us is the Dhanteras. It starts during Navratri and it builds up to the Dhanteras. So I don't think that had much of an impact. And on the other hand, actually, while the situation was grim, we were, we participated in various sponsoring various pujas and whatever, be it across the country, which various cities, and we wanted to be a part of the culture, and as a brand belonging from this particular part of the country, we thought that we should support the Durga Pujas in all across the country and across the world. So we did what we had to do. So I guess that we weren't so much impacted by it.
Understood. Last one thing I wanted to understand, one of your comments. So H1 we have delivered about 20% growth, and YTD, if I heard it correctly, you said it is 15 to 18, right? So if you could just confirm this number.
15. YTD is 15, and H1 is H1
fiscal.
17%.
See, control revenue, if we take the number, also, it has increased from 2452 to 2904. It is 18.5% console revenue.
Console revenue is 18.5 versus 18% growth in H1 is what you are saying.
17% growth in H1.
Correct.
And console is 18.5.
Yes.
Correct?
18.5. Okay.
And YTD, this is like latest, is 15% approximately as of there. Because the last year Dhanteras was in 10th of November and we are speaking on today 14th of November. So this is just an update.
Sorry, I will just add here, Johnson. See, when the festival ends, so as we said, that Dhanteras has been excellent for us, and Dhanteras sale, this month we did almost 1,000 crore. So obviously, post Dhanteras, 5, 6, 10 days will be slow. Okay. So what sir has quoted as 15% is the post Dhanteras effect. So now that we are talking about some 40 lakh wedding, okay, and a major part of wedding which has been shifted to Q3. So the 15% as of today, which sir has said, will again become 18 to 20%. So
Understood. Yeah. So it is the in this period there is a larger period that we are including, which is leading to some slowdown, and things should eventually pick up. Is this the right understanding?
So it is not slowdown. Let's not call it slowdown. People have bought in huge bulk.
In huge amount.
In huge amount. So it is just a short cooling off. It usually happens after every festival. So Akshay Tritiya, post Akshay Tritiya, 2 weeks will be slow. But at the end of quarter, it will be like this. So at the end of Q3, you will again see 18 to 20%. I'm not saying more than 20. So I'm saying 18 to 20 at the end of Q3 for 9 months.
Understood, sir. Thanks for answering the question.
Thank you. We'll take the next question from the line of Gaurav Gandhi from Glorytail Capital Management. Please go ahead.
Yeah. Thanks for the opportunity. Sir, this is the time in the market where everyone is bullish on the jewelry, fashion jewelry, or the business you're starting under Senco brand. Every company is adding stores and increasing square feet. As an investor, we always have a concern regarding unit economics or per store economics. Growth is good, but it should come effectively, with sustainable profits. So while growing the new business under the Senco brand or the existing business, how much do you focus on the unit economics or per store kind of metrics? Your thoughts on this?
Yes. No, our focus on unit economics continues to remain. I'll tell you how, is because when we are planning our expansion, we want to continue to expand and penetrate deeper and deeper into the East India market. So in our growth expansion plans, almost 65 to 70% of the new stores that we add is in East, which is our strength. Around 15 to 20% would be North, and the rest would be West and South, because the balance between economies of scale and leveraging on the brand goodwill so that your profitability remains high has to continue. And that is where, even while Senes as a brand is created with a long-term vision, but we are focusing on expanding in the Eastern market where our strength lies, and we will build up the brand, the unit economics. But again, at the same time, when you launch something new, while Senco is a 85-year-old legacy brand, and whatever profit, growth, goodwill, everything that we are benefiting out is of the effort put over so many years. When you launch a new brand, a new product, obviously you will have to invest a little bit with full optimism that over the next 2-3 years, this will become a profitable brand. So initially it is at an investment stage. That's why we are not going all out and expanding rapidly, in a very, I would say, very aggressive way. We are going step by step, 4 stores, 5 stores, 6 stores, 10 stores. And as we open, we are looking at the consumer behavior. We are analyzing the data. What is the product consumers are asking for? We are rationalizing the marketing expenditure, investing a little bit out of the Senco branding and marketing budget into the Senes marketing and branding budget, building the website. So yes, that balance is important. So 80% is profit, 20% is future growth. I would say that's a good way to look at the overall future strategy.
Thank you very much, sir. Ladies and gentlemen, we will take that as the last question for today. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Okay. So, thank you everyone for the time that you all have spent with us to understand about our company. The coming wedding season, with the data that speaks of more than 40 lakh weddings in the month of November, December, January, February, up to March, will act as a full trigger. And along with the wedding season, any kind of buying and purchases that is linked to weddings, I think will all act as a great boost to the industry, and not only to us, to everyone. We are also very hopeful that the price fall in gold that we have seen over the last 15 days will also act as a boost to the industry. Many consumers who have been waiting in the sidelines to buy jewelry if the prices become reasonable will again want to utilize this opportunity and buy the jewelry once again. We are taking our initiatives of expanding, of promoting amongst our customer base and also the new customers that we are reaching out to, so that they can come and buy. The new collection, the new campaigns will be starting for the wedding season in November, December. January, February again will be a focus on diamond jewelry with the Valentine's Day and the love season, as we call it. And also, just to say that, we at Senco, along with the growth, along with the profitability, we are trying to, encourage in terms of the various best practices. In this particular quarter, we had been awarded from MCX as one of the best hedgers in the jewelry industry. In the month of August, we were very, fortunate to be a part of the Morgan Stanley Capital Index for the small caps. So that has been, I would say, a great trust that the investors have posed on us, and we want to live up to their expectation. We have also won an award from Network 18 called the Green Ribbon Champions for Excellence, because, through our business, along with that, the way we are promoting Old Gold Exchange, gifting of trees to the consumer and taking certain initiatives for protecting karigars and women empowerment. So we also were a part of an event called the She Shakti, And it was very important that while we went through the season of Shakti with Durga Puja, Kali Puja, that we always women consumers are 85% of our customer base, and whatever initiatives we can to support women is something that we at Senco believe in. So we will continue to focus on other aspects along with our business, and the lab-grown diamond jewelry will be strategic in nature. We will keep judging how the consumers are reacting. There is a demand, there is a market, but it also will need a kind of awareness and push from our side, and we will take a calibrated approach towards the lab-grown diamond and the new products. And as far as diamond jewelry is concerned, we are confident that in terms of pricing, in terms of designs that we are creating, we will be amongst the best in the industry. And it is up to us that how much we can penetrate and reach the customers so that this stud ratio that we are currently in can improve. Our endeavor is to take the stud ratio towards 15%. Currently, last year it was 11. We were aiming that this year we will be closer to 12, 12.5. Due to the market condition, we are stuck at about 10, but we still have 4-5 months time. And I think we'll put all out effort to increase the stud ratio with the designing as well as the pricing. And as far as competition is there, we must say that the industry overall is doing good. We are trying to support each other, sharing our challenges, our problems, and trying to work together towards it. So yes, I think consumers are benefiting from the expansion of the industry. It looks that amongst the various sectors, our sector continues to remain attractive because of the returns that the consumers are getting. It is not only adornment, but it is also an investment. But it is not only that amongst these organized players that we are kind of competing us against. The unorganized to organized shift continues to happen with the branding effort, with the design effort, with the expansion. And we should all enjoy the benefit of the shift that we see in the industry. So thank you once again for your time and look forward. And today is Children's Day. So while I would say that there is a child in all of us and that enthusiasm and energy is needed so that we can continue to grow in the future. So happy Children's Day to all of you.
Thank you, members of the management.
Thank you, everybody, for joining the call. We really are grateful to all our investors for showing faith and trust in Senco growth story. Thank you.
Thank you, sir. On behalf of Emkay Global Financial Services, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.